Well, hello everyone, and thank you for joining us for our sixth episode in our Riskology series. Today, we're going to be talking about the basics of LGM, Livestock Gross Margin, which is another one of our livestock insurance products that we offer here at ProAg. Just a reminder about our Riskology series. As we mentioned, this is our sixth one. If you're wondering what we have done in the past or look forward to what we're doing in the future, you can log in at any time onto YouTube and search Professional Ag Marketing to see the past episodes of our Riskology segments, or you can go to our website at professionalagmarketing.com and click on the YouTube link in kind of right in the middle center part of the page at the top part of the website and check those out. These series are intended to kind of give an overview of the basics of risk management from insurance products on the livestock side, like today, crop insurance, futures, options, and traditional risk management tools and plans. We'll have one every month for the entire calendar year, so we should have 12 by the time the calendar rolls over. So please check those out. And if you do have any questions about something you see in one of the Riskology episodes or of this information today, please reach out to us at Professional Ag Marketing. Either click the link on our website, email one of us, or give the office a call at 507-449-2030. With that, we are going to get started today on the basics of LGM. My name's Lucas Peters, kind of the director of the insurance department here at Professional Ag Marketing, and we're going to talk about an insurance product today that is probably one of the more underutilized livestock insurance products to date. But we are going to suggest that, especially if you're feeding cattle, this is something you should consider going forward. So our agenda for today, we're going to go through a little bit of the background on the insurance program, highlight some of the basics of LGMs, a quick view of the claim process, look at what will change for the 2027 insurance year, which will begin July 1st, wrap up with a summary. So that's what we're going to talk about today. So a little bit of history. Both the LRP coverages, which we talked about on our last month's Riskology segment, and the LGM product were released in the early 2000s, and all have been available for coverage on swine, or LGM specifically for swine, feeder, swine, cattle, and dairy. Okay, DRP is another insurance product that was developed in 2018 that is specifically around dairy, and DRP had a little bit of momentum when it first released, but it really took a subsidy increase in 2020 for LRP and LGM insurance to take off and be widely used in the industry as risk management tools. Participation increased dramatically, especially on the LRP side and here lately on the LGM side. And a reminder that when we talk about livestock insurance, it always falls under the crop insurance umbrella when you're looking at USDA, RMA, since they are subsidized insurance products, just like crop insurance. And so that brings with it all the usual crop insurance regulations and forms and programs we have to deal with. But that's why you'd work with experts like us at ProAg with your products. All right, specifically around LGM, livestock gross margin. So it's available on cattle, swine, and dairy. So let's look at that a little bit. Cattle would be cattle that we are essentially fat cattle, growing to sell, not feeder cattle like we were doing with LRP, or cows, which would be not covered on any product currently. Swine would be typical to LRP. We have a farrow to finish option. We have a kind of an iso wean option and a finishing option. And dairy, we aren't going to talk about the dairy product today, but it is available on dairy. The gross margin is available on dairy as well. And so it is a margin product, so we're covering or insuring the margin. So revenue minus input costs or feed cost. So what does that look like? For cattle, we are going to take the revenue of our live cattle we're going to sell, and we're going to subtract off the costs of feeder cattle and corn at varying weights that are kind of set by the policy. And that difference, that crush of the revenue, is the dollar amount we're going to insure. On swine, we're going to take the revenue side of the lean hog sales and take off corn and soybean meal expenses for our crush on the swine LGM. What main difference between LGM and LRP? LRP is available every single day that the market is open. LGM is only available once a week. So every Thursday from about 3 p.m. in the afternoon on Thursday through 8:25 a.m. the next day, the cattle and swine LGM are available for purchase. So you get once a week to look at the LGM coverage. And if you miss it or if it's not available that day, then you'll have to wait for the next week. Okay, so what would cause LGM not to be available? If there would be a report falling on a Thursday, such as a hog and pig report or a cattle on feed report, normally released on Friday, maybe for some reason it's released on a Thursday, LGM would not be available those days. Or, which we actually saw recently in the market, if we have a limit move on one of either the cattle or the input side, then LGM is not available for sale on those days as well. When you do LGM, another difference between LRP, we have to look at per head deductibles. Now, we have lots of different options, and we'll look at them here a little bit later. But essentially, we have on cattle side, we have $0 deductible through $150 deductible. Okay, so at a $0 deductible, it's going to be more expensive for the producer because you're taking on less risk yourself, right? If you are buying a coverage essentially at the market, it's going to be more expensive versus a $150 deductible where you're allowing quite a bit of loss before you start collecting. That coverage is going to be cheaper. Okay, kind of the sweet spot in deductible on the cattle side is $70 deductible. We'll look at why that's the sweet spot here in a minute. On the hog side, again, we have deductible options from $0 to $20 in $2 increments. A lot of times we have producers using a $10 deductible, although sometimes we look at $6 and sometimes we look at a $0 deductible on the hog side. Compare that to LRP, where we buy coverage levels. Usually 100 to 95% coverage level is where most of our coverage written goes. You can buy down to 70% coverage level, but that is another give and take where LRP in our office, we're probably more at the 100% coverage level. With LGM, we're going to be looking at a $70 deductible per head on the cattle and probably $10 on the hogs. So coverage is based on that kind of set feed usage and animal weights that the policy provides. The swine side is locked in on the weights of the swine. They're going to use a 1.92 carcass weight for calculating revenue, and they're going to use a certain amount of corn and soybean meal depending on whether you're insuring a farrow to finish or an iso wean situation. On the cattle side, we have a little bit of flexibility. We can input the weight of our marketed fat cattle, and we can change the weights of our inputs on our feeder cattle and corn a little bit. But our max weights on cattle for 2026, calf finishing is 1,300 pounds, yearling finishing is 1,500 pounds. So we're probably going to max out the weights most of the time when we are looking at LGM cattle. How many LGM can we do? Well, we can cover the amount of head that the producer will market in each month. Okay, so again, a big difference between LGM and LRP. LRP has a specific expiration date. LGM expiration is in the month. So if we want to insure August fat cattle, we can insure however many cattle we're going to market in the month of August. Okay. LGM requires marketings in at least 2 months to qualify for subsidy. And obviously, we want to qualify for subsidy if we're doing an insurance product. So we are going to insure, if we're in that example, insure August fat cattle. We're going to put the number of head we want to insure or how many we're going to sell in August. And we're going to put that in August. And then we're going to have some head, even as little as 1 head in another month in order to qualify for the subsidy. All right, so we talked about the subsidy change in 2020 and the corresponding growth. This slide kind of looks at all three available LGM products, the cattle, dairy, and swine. And you can see the dark blue, the largest line there is dairy cattle. Partly the reason why it's so large is because it is using pounds and everything else is using head. So there are a lot more pounds insured of dairy than there are head of cattle. But it is important to note dairy is a large piece of the LGM program today. I would expect 2026 to be more than 2025 sales, so kind of just a continued increase in sales here on the dairy side. On the swine side, we kind of maxed out back in 2024. 2025 had a similar number of head insured, and 26 it does not look like we will get back to those levels that we had insured previously with LGM specifically. On the cattle side, I do want to look at that number. That's the smallest number there. It's kind of the far left bar showing up. You can see a steady increase in cattle insured on LGM, right about 889,000 insured in 2025. The 2026 number, actually, we were looking at that earlier today. We're going to be close to 1.1 million head insured, if not more, depending on what the market does here in the coming weeks. So a steady growth in the LGM cattle side, and we'll look at why that might be, why LGM cattle might be a good opportunity or a good place to use LGM here in just a second. Now, we talked about the subsidy and the deductibles. Okay, so subsidy goes up as deductibles go up as well, right? Again, lower deductible, it's going to be more expensive for the producer because they want less risk. Higher deductible, producers taking on more risk. The government rewards that by offering more subsidy or more discount to the producer. On the cattle side, you'll see the $0 to $150 deductibles available. 70 is where we insure a lot of our cattle at, and nationwide, it is the most popular deductible used. And you can see there the reason why is because at $70, we hit the max subsidy at 50%. So at $70 deductible, roughly $5.38 a hundred if we're using a 1,300 pound fat cattle sale with calf finishing LGM. So roughly a little over $5 out of the money coverage. It's going to be subsidized 50%. Very good savings, probably your lowest cost option for putting a floor on fat cattle, especially in today's market with the volatility in the live cattle. Put options are pretty expensive. The LGM coverage can be an awesome alternative if you are looking just to put a floor on and a cheap floor. It's not going to be at the money, but it's going to be $5, a little over $5 back, and we would think that is an awesome coverage to put on if you are interested in using an insurance product. On the swine side, on the left-hand part of the screen there, you can see that the 50% deductible is hit at $12. 50% subsidy is hit at the $12 deductible. We use a lot of $10 deductible. We're at 47%. But I mentioned we do have some producers that utilize the $0 deductible with LGM swine. At $0 deductible, the coverage is still 18% subsidized. When we do compare LGM and LRP quite a bit. So where is the LRP subsidy at? Well, at 100% coverage price, which would be similar to a $0 deductible LGM, LRP is 35% subsidized. So that's where we kind of, with LGM, we do look at a higher deductible in order to get more subsidy and lower the cost compared to LRP. All right, so going into a few more little topics on LGM. Let's say we have a producer and we want to insure some of our livestock with LGM. What are the choices the producer has to make? First, we got to look at one of the choices, I shouldn't say first, is that deductible. We got to look at what risk profile is and decide what deductible level he's going to be at. So $70, $0, $10 in the hogs, where is his best option? What is he looking to protect? The next, we have to look at how many head we're going to insure in a month. And we can go up to 6 months out for swine coverage, up to 11 months out for cattle coverage. Now, we generally do not do that, and we'll look at why that's the case here in a little bit. But most of the time on LGM swine, we're going to be looking 2 to 4 months out. On cattle, we're going to be looking 2 to 8 months out from the current month. And that's going to be kind of our area that we're insuring. So we do have to look at how many head are we going to expect to sell in that month, and what percentage of that head do we want to insure. And then, as I mentioned previously, we do need to have coverage in 2 months in order to qualify for subsidy. This is something where we need 2 months. We can't get around that. But if we are only interested in buying coverage specifically for 1 month of cattle, like in our previous example, we used August fat cattle. If we really only want to cover August fat cattle, we would put our main number of head in that month, and then we can do 1 head or 5 head or 10 head in another month. That qualifies us for the subsidy, which is important, but if that second month doesn't have as many cattle in it, so it shouldn't affect the main coverage that I'm after, like in that example with August cattle. One cool thing with LGM is there's no minimum head requirements, so we can do as little as a couple head, but there's also no maximum. And so with some of our larger producers, on the cattle side, that becomes very important. LRP has some maximum limits, 750,000 head on swine, 25,000 head on cattle. And so if you are a large producer where you're going to hit those numbers, you're going to want to look at LGM, because now your opportunity isn't capped at a head limit. You can do as many as you want during the insurance year. Insurance year runs from July 1 through June 30th. Premium, you do have to pay for the coverage, but that is not due until 2 months after the coverage is over. So LGM, exactly like LRP, 2 months after coverage is over, very friendly for cash flow purposes, that we don't have to pay for it up front, and no chance of margin calls for the insurance coverage during the time when coverage is on. Expected prices for LGM. So we talked about this as a crush product. We have our revenue side and our input side. Obviously, the day we put that on, those Thursday afternoons, we're going to have an expected price for all the months going forward to determine what months we want to add coverage on. Those expected prices and the expected margin for each month is calculated based on where the futures price ended that day. So if we're looking at August cattle or December cattle, we'll look at the futures for December, for example, December fat cattle, and wherever the futures close on that day, that's where the expected price for LGM for December will be at. Obviously, if we're looking at deductible, then our coverage is going to be off of the December market and less our deductible. The actual values are calculated based off of an average of futures prices. Okay, so corn and soybean meal on the swine side, corn and feeder cattle on the cattle side are calculated using a 3-day average. It kind of depends on the contract month and what each kind of input you're calculating there, but it is a 3-day average prior to the contract close or the month end, depending on the time of month or a time of year we're in. But 3-day average of the futures prices. For fed cattle, it again uses a 3-day average, and that's going to look at the 3 trading days prior to first notice date or the 3 days before the last day of the month, depending on what month you're in for that fat cattle. But again, a 3-day average of the futures closes. Swine uses a 7-day average of the futures closes, 7 days prior to the last trade date or 7 days prior to the 14th of the month or excuse me, 7 days prior to the 10th business day of the month if we're not in a contract month. So that is kind of unique with LGM. When we calculate those ending values, it is going to be an average of the futures prices. Compared that to LRP, where we have a specific day, and wherever the market is on that day, that is our ending value. Okay. An important difference also is that LGM, those averages are based off of the futures market, not on any of the indexes. So remember, on LRP, swine, for example, LGM is going to settle wherever the lean hog index is that day. Fat cattle is going to use the 5-state area cash over 80% choice category to settle LRP. LGM is going to be an average of the futures prices. So there can be good and bad, but I think during times of the year, there is an advantage to using futures prices for settlement, and that's where the times of the year where LGM really works well. All right, so the input side of LGM expires a few months before the revenue side or the livestock side. So for swine, corn or soybean meal are going to expire 2 months prior to the swine. If you are doing the iso-wean or the finishing categories on the swine LGM. If you're farrow to finish operation, those corn and meal prices are going to expire 3 months before the swine expires. On the cattle side, calf finishing, for example, the feeder cattle are going to expire 8 months before the fed cattle, corn 4 months. So kind of interesting is that it's not going to all expire at once. And also we're going to put coverage on, and we're not going to have all legs of our stool. Sometimes we're not going to have all legs of our stool, our calculations set. And that's okay. We get a little bit of coverage for a little bit of input coverage along with our livestock coverage when we're doing LGM. That expiration of LGM against futures is a key difference versus LRP, but we already hit on that. I think our quote that we send out on LGM cattle helps explain when these inputs expire and the cattle side expire and how they can work together a little bit. So here's an example quote. This is back from February, and you can see our live cattle months there on the very top and our feeder cattle below that and corn after that. The red months, or the red highlighted months there, means that the feeder cattle or corn have reached expiration and are set. So for the months of April and May, on our quote example there, feeder cattle price was set, corn price is set. So now that LGM coverage is strictly a floor price or a put option on April and May cattle. Okay, so can use that to our advantage if we understand that going in. We know that when we lock in our LGM, whatever that expected price is, minus our deductible, is our coverage price for the cattle. That will not change. Let's look between the June and September time period when the feeder cattle price is set. So that part of our equation is not going to move, but corn price is not. So we have our cattle price that's in flux, and our corn price is in flux. So that can affect where our floor price is on our cattle. If corn price moves up, so corn's getting more expensive, our cattle price is going, or our cattle floor is going to go up as well, right? Because if we have more expensive corn in our calculation, we're going to need more expensive cattle to calculate the same margin that we insured. If corn price goes down, our cattle floor is also going to go down because we don't need as high-priced cattle to keep the margin we locked in when we bought the LGM. Now, that relationship can get kind of complicated, and that is something that we watch a lot at ProAg to try to weigh that value of kind of changing floors on cattle price based on where corn price is moving. A good rule of thumb is to think of if corn price moves 50 cents from expected to actual, that's going to move your cattle floor about $2. Okay, so 50 cents is a big move on corn. $2 probably isn't that big a move on cattle anymore, it seems like. But that is something to keep in mind on how the corn price can affect your live cattle price. Now, when we look at the months of October through January, you can see that the feeder cattle are open and the corn is open, meaning they're not set. We generally do not sell LGM into that time period because it's hard to basically you aren't buying a specific cattle coverage there because everything's moving together. We would suggest that probably isn't the best use of LGM. We would rather have at least our feeder cattle price set before we'd be interested in looking at locking in coverage for our live cattle price. You can see on that quote there as well, kind of in the bottom, how the LGM coverage compares to the put options continues to be significantly cheaper than a corresponding put option. That's why we usually say LGM is your lowest cost option if you're looking to put a floor in on your livestock. Really something to consider for that. So wrap up with some kind of some pros and cons here on the basics. Pros, it is subsidized, especially at those higher deductible levels where we can get 47, 50% subsidized, really cost effective, can fit your operation of size and dates, match up when your livestock are going to get shipped out, and fits all operations because there's no minimum, but there's also no maximum, so fits every size across the country. You get to pay at the end. There's no margin calls, so it's very cash flow friendly. Covers input costs and revenue versus LRP, which we're just insuring revenue. At least with LGM, we can get some input coverage if we buy, a few months out when we're locking it in. Another pro I'm going to put on here is futures expiration. Of course, that can be a con depending on the time of month and the type of livestock, but generally we're going to use that as a pro. What are the watch-outs or the cons of the LGM? Just like LRP or any of the insurance products, you are locked in once you purchase it. So there's no trading, changing your mind and trading out of it. Once you sign up for a coverage, you are locked in. There's no speculation. You actually need to have as many cattle or swine as you insured. You do get a little bit of wiggle room there. I don't think we mentioned it yet, but we only have to prove 85% of our actual marketings to allow for a little bit of change in management or death loss or things like that. But there is no speculation. You actually have to own cattle. And one of the other biggest cons of LGM and why I think it isn't as popular nationwide as LRP, there are a lot of multiple moving parts that can change coverage levels and limit payouts. We have inputs, we have the revenue side of the livestock. Compare that to LRP, which is very simple it's the price of cattle, it's the price of feeder cattle, it's the price of swine, it's a specific day, very easy to calculate and show. LGM has a few more moving parts, but if you can understand those moving parts and the deductibles and look at how that subsidy, maxing out that subsidy can benefit you for a low-cost floor, I think it's worth something to consider. On the claim side, we do have to show all the number of head we insured in the month. So if we insured August cattle and one of our endorsements had a claim, we have to show sales for all the head we had insured in that month, even if the endorsements didn't have a claim. So it's a little different than LRP, but if we're insuring it, we have to have record of those sales. We don't get quite a wide as window for proving sales on LGM as LRP either. So LGM is going to be all those head that we insured in that month, and they're going to give us 15 days prior, 15 days back into the prior month and 15 days forward into the next month to look for sales for LGM, any potential claim situations. Claim forms are released roughly 5 days after that averaging period. Again, all marketings have to be reviewed before the claim is paid. And this goes to show, like crop insurance, like LRP, LGM's no different. Keep good records and your claims process will go remarkably easy. All right, so 2027 changes. Not many changes, but some positive changes on the LGM for the 2027 crop year, which will begin July 1. A few more wording on subsidy capture. That's very similar to what the LRP language is. A little more kind of some examples there on that subsidy capture and what it would be a violation. One of the biggest changes there is that second bullet point. This year for 2027, they are going to allow concurrent coverage between LRP and LGM. So in the past, this was not allowed. If I had an LRP policy expiring in a month, I was not allowed to have LGM expire in that month or vice versa. For 2027, as long as my LRP and LGM policies are with the same insurance company, those two policies can have had expire in the same month. So positive change there, that we can use both products when they work best for our producers, and not be limited on what we might have done in prior months. If we have if we write a policy and there's no premium earned within 3 years, that policy is canceled. And another positive change here, an increase in max weights. What we're seeing, of course, is cattle are being fed longer and getting bigger, and the policy is changing to allow to be insured heavier cattle. So now calf finishing is going to be we can insure up to 1,600 pounds on calf finishing compared to 1,300 pounds this year. So big change there. And yearling finishing, we're allowed to go up to 1,800 pounds compared to 1,500 this year. So nice addition there, increase in weights. One thing we do have to watch out for is with LGM cattle, we are allowed to put in our corn and feeder cattle weights. The biggest difference between our final fed cattle weight and our feeder cattle weight cannot exceed 1,000 pounds for the calf finishing or 600 pounds for a yearling finishing. Meaning if we're going to insure a 1,600 pound fat cattle at expiration with calf finishing LGM, then my feeder cattle have to be at least 600 pounds. So just a little watch out there, but overall a positive change for 2027, allowing us to insure heavier cattle. All right, our summary, just like LRP, these livestock insurance products, LRP, LGM, are great tools, but they are not the silver bullet. They have some key advantages, mainly being the subsidy, the government discount offered by using the products, but they are not a complete replacement for a solid risk management plan. Working with somebody that understands the times of when the insurance products work well in conjunction with a standard futures and options risk management plan is a great can be a great asset for you, the producer. So if you ever have a question on how those can work together, we would encourage you to contact us here at Professional Ag Marketing. There are certain times of the year where it's going to be more advantageous to use LGM. There's going to be certain times of the year when LRP would have be a little better. And we've worked with both of these products for years and understand when to use each of them. And we would encourage you to work with somebody who gets the whole pictures, uses all the tools, understands all the tools, so that you can get a solid risk management in place for your operation going forward. Thank you for joining us on the Riskology series around basics of LGM.